So welcome to the Loan Doctor podcast. Okay, so we turn home buyers into homeowners, but there's also 4 C's to a mortgage.
There are. So when somebody is getting a mortgage, we're looking at credit, we're looking at collateral, we're looking at capital, and we're looking at cash flow.
What is collateral?
So the collateral is how much that property is worth relative to how much the bank is going to lend on it.
What is the cash flow?
It's your income minus your debt and obligations.
Okay, now you mentioned capital.
Yep.
What is that?
Capital is really how much money do you have.
Okay, and then lastly, you said credit.
Credit is going to be the biggest indicator of rate and terms. Something people don't realize is that credit is really about a willingness to meet your obligations and not a measure of ability. It shows somebody who's going to give you the money that you prioritize the importance of paying them back.
The way you just described it, I hear ability to repay.
All loans have to demonstrate an ability to repay. How that ability to repay is determined can vary by institutions or by loan programs, but everybody's got to have some basic guideline to say the likelihood of this loan getting paid is going to be good. You have to be proficient in all 4 areas to get the best rate and term.
When you say the best rate and terms, does that mean I should always check the interest rate?
Your interest rate is an important factor in how much you pay.
So Richard Brandt, the loan doctor, you turn home buyers into homeowners at the Brandt Lending Team. And it's a family business.
It pretty much is a family business. I definitely am a believer in nepotism.
And they're all very successful because I know them.
The truth is, the reason that we're successful is because we help people the right way. And as long as we maintain that attitude, I think success is just a byproduct.
So welcome to the Loan Doctor podcast. It's all about you and about mortgages
Okay.
and how we're going to get approved for one.
Yes.
Okay, so we turn home buyers into homeowners.
Yes.
Okay, that's what we do at North Point Bank and at the Brandt Lending Team. So with that said, let's talk about the most basic thing of all, which are the 4 C's. I know that in a diamond setting, you need the cut, clarity, color, and carat. Those are the 4 C's of a diamond, but there's also 4 C's to a mortgage.
There are. Yeah, when somebody is getting a mortgage, the bank is really looking at 4 C's as well in terms of somebody being qualified. We're looking at credit, we're looking at collateral, we're looking at capital, and we're looking at cash flow.
So going back to the 4 C's, let's tackle each one of those one by one. Okay. What is collateral?
So collateral is the property. So when you're getting a mortgage, the mortgage is against a specific property. So the collateral is how much that property is worth relative to how much the bank is going to lend on it.
So is that kind of the down payment when you're looking at that number because you want to make sure that the bank is not at a loss upon the start of the loan?
Yeah, part of it is down payment. That's part of the equation. If it's a refinance, it's really about how much equity you have on it. But when a bank is making a lending decision, there is a different evaluation if you're putting 5% down or if you have 40% equity.
So that's the collateral.
Correct.
What is the cash flow?
So cash flow, this one's really important. Cash flow is a measure of how much money do you have going in versus how much money do you have going out. It's your income minus your debt and obligations. And when we're talking about debt and obligations, we're talking about things like your mortgage payment, your property taxes, your insurance, your HOA if you have one, credit card debt, student loan debt, auto loans, and stuff like that. We're not talking about like how much your insurance might cost or your utility bills and things like that. We're really measuring those credit liabilities along with your house payment.
Okay, now you mentioned capital.
Yep.
What is that?
So capital, these are great questions.
We're breaking down each one of them.
That's right. So capital is really how much money do you have? How much money are you going to use? Where are you getting the money, right? And then how much money will you have left over when the process is done? So if you're making a purchase, right, if you have 6 or 7 months of reserves, and what that means is that you have the equivalent of 6 months of the monthly payments in the bank in cash, that's a really good sign, right? That if something were to go wrong, you would still have the ability to make the payments on the mortgage.
Okay, and then lastly, you said credit.
Credit. This one's really important.
And I think a lot of people take this for granted when they're making the small payments of $30 towards their credit card or just not really thinking about those student loans so much because they're waiting for decisions to be made. But in the meantime, it is affecting your credit.
Credit is going to be the biggest indicator of rate and terms. When anybody is getting a loan, you're very much getting the terms based on the pieces of your financial puzzle. So those 4 C's that we kind of talked about, credit is one of those big things that really make a difference on what type of rate you might get, or even if you qualify, as well as because credit is also going to have an impact on your cash flow. Something people don't realize is that credit is really about a willingness to meet your obligations, and it's a measure of willingness and not a measure of ability.
That's always been interesting to me because I've seen people who have $1 million in the bank and yet they still have poor credit.
Right.
And you think, "Oh," and the bank has to say no.
Correct.
But you've got $1 million in the bank. Obviously, I could pay, $200,000 if I've got $1 million. Because
Yeah.
you've shown that even though you have $1 million, you don't pay.
You don't prioritize it. It's really
Right.
about willingness. The funny thing too is that a bank, in a lot of respects, will forgive an interruption in ability more so than they'll forgive an interruption in willingness. If somebody just decides that they don't care if they're paying people back or not within their obligations, the bank is going to be real reluctant to give them a loan later. But if somebody had a job and then lost their job, or had some type of hardship, the bank is much more willing to overlook that kind of stuff just because it was a temporary interruption, as long as it's, there's some reestablishment.
So is it correct to assume that credit is more important than the other three?
Credit in combination, yeah, credit is probably the most important. The other day, I had somebody come to me, I think we talked about it, with like a 450 credit. They wanted to buy a property with minimum down and
Okay,
a 450 credit score.
Hold on. When you say 400, people really are not expected to know what a 400 means. What is an average score?
Okay, so an average credit score is in the 700 range. A good credit score is like 720 or above. 850 is about the top that you can get. 600, you need a little bit of help.
So having a 400 is really bad.
Having a 400 is really, really bad. And all I can remember thinking is this person doesn't pay anybody back, right? And now she's asking to get another loan and she pays nobody back. And the only thing that I can think of is that if anybody gives her money, she must assume it's a gift, because who'd be stupid enough to lend me money? And so I think that's why it just kind of goes into a vicious cycle and nobody gets paid back.
So if she paid all of her bills for 12 straight months, she would have really bad credit.
She would be lucky to have bad credit.
she would go for
Yeah.
Yeah, you have to watch it with that because that's crucial.
It's the most important thing that you can do when you're about to borrow money is show somebody who's going to give you the money that you prioritize the importance of paying them back.
We said credit may be the most important. What would be second to that? Which are the areas that we really need to pay attention to? Because does it depend on the loan, or does it depend on the amount, or how does that work outside of credit, the other three?
They all kind of work together. And one of the things that I tell people, when you want to get the best rate in terms, those 4 things, you have to be proficient in each one. And I kind of use high school as a metaphor for it. And the reason I say that is because think of the 4 C's as subjects in school. Remember when we were in high school and you got an A+ in English, an A+ in science, and an A+ in history? Did it have anything to do with your grade in math?
0.
Right.
But it would have been really helpful.
Right. Yes, it would have been. Could you move any of your English over to your math to kind of help out?
No, but
Nope.
can I show you one area so that the bank will say yes?
Right.
If another area is not so great?
Well, that's exactly right. So in lending, those 4 things are kind of independent. You have to be proficient in each one. And then there's a cumulative aspect of it too. Because think of it, going back to the high school metaphor, think of it like GPA, right?
Mm-hmm.
If I got all D's, I wouldn't pass high school, right? But if I got a couple of A's, a couple of B's, a C, and an occasional D, I'm okay. I can't get an F and pass anything, right? Mortgages kind of work the same way. I'll give you an example. If I have, let's say, low credit and a small down payment, and my income is barely making it and I don't have any reserves, well, that's going to give me a low GPA that might not be enough to qualify.
The way you just described it, I hear ability to repay. Because if you say I have a low credit score and then not a lot of income, not a lot of money in the bank, maybe not another property, my ability to repay, my choices are slim.
That does impact your ability to repay. And I think one of the things that has changed from the early 2000s when we had that housing crisis where you could basically fog a mirror and qualify for a loan,
Right.
right? That kind of changed. In 2012, there's something called the Dodd-Frank Act that came out. And the Dodd-Frank Act basically spells out the ability to repay. All loans have to demonstrate an ability to repay. How that ability to repay is determined can vary by institutions or by loan programs, but everybody's got to have some basic guideline to say the likelihood of this loan getting paid is going to be good. And it's really about setting people up for success because what happened in the 2000s is in the early 2000s is we set people up for failure. And that's just not something I'm going to do. In fact, speaking of that, I had a conversation with the realtor yesterday who sent me a client who's a VA loan. They want to buy a property with 100% financing. Credit's not so great. And he's been living with his family for 2 years. He's about to undertake a payment that's $2,000 a month. He's been living with his family for 2 years, so he's had no mortgage payment, right? And his credit isn't great. And he hasn't been able to save any money. If you haven't had a payment for the last 2 years, and now you're going to have a new $2,000 payment, and you haven't been able to save money, am I setting you up for success? Tell me what I'm missing. It doesn't matter. I don't care that you qualify. I want to know, tell me what I'm missing because I want to make this successful for you. This isn't just about you getting a loan and me making money. This is about making sure that in 2 years, you're still in that house.
Well, on the line of what you just said, I've heard a lot of people say, yeah, but you're not considering that I'm about to get this job or I'm about to start Social Security or I'm about to start getting pension or what
Yeah.
have you. Does the bank consider in the next few months I'll be receiving these checks?
Yeah, so there's a couple things that the bank is going to consider depending on the type of income. If you went from not having a job to getting a job on Tuesday, that's going to take a little bit of time for you to establish enough of a pattern that the income could be considered reliable. But if you're getting something like a pension or something like that, and in the story that I just kind of described, it was really about me trying to figure out, tell me what it is that I'm missing about your puzzle that I might not see in your profile that says you're going to be okay to afford this house, right? Maybe you might, just because you were living with family doesn't mean you weren't paying anything, right? You might have had a lot more debts and you were able to bring your, $50,000 in debt down to 10. That could have happened too. Like, I don't see that kind of stuff. So I just want to know what's happening there so that I'm making sure that we're doing right by the client. And I
Okay.
think he appreciated it too.
I've heard you say 5% down, 10% down, 20% down. Does that depend on the client or the type of loan that they get?
Oh yeah, both. So with certain loans, right? You can do with like a VA loan or a USDA loan. You could buy that with 100% financing.
So 0%
Zero
down.
zero down payment, right? Most loans are going to be 3% down for a first-time home buyer, or 3.5% if you're doing an FHA, and then you can put down 5, 10, 15, really any number that you want. And part of how we decide how to do that is really about our clients' needs. How much money do they have? Where do they want their payment to fall into? And then what's their price range? What prices are they looking at in terms of property? And how those numbers intertwine is kind of where we come up with the best scenario for somebody.
Everybody talks about the 30-year fixed. It seems to be the go-to loan of loans.
Mhm.
But is that the best option for everyone?
In lending, there isn't a best option for anybody, for everybody. Everybody's situation is a little bit different. If you think about somebody's financial puzzle, it's like a snowflake. They're all different. And so a 30-year fixed is good in many situations. It's good for a lot. It doesn't mean that it's the right fit for every situation. And part of going to the right lender is making sure that you're going to a lender, whether it's me or anybody else, who listens to what your goals are, who gathers the pieces of your financial puzzle and then blends that together to give you the best loan product for you.
Well, going back to the four C's, when we say credit, let's say that woman who had a 400 and she says, okay, well, can you help me in any way? What do you say?
Yeah, that's a great question. So for us, one of the things that we do is we make sure that if somebody has a priority to want to own a home, then what we're gonna do, if you're not ready today, we're gonna structure sort of a mortgage roadmap that will help you be ready in the future. It's going to have a specific time frame. It's going to even have benchmarks that you're going to do that we're going to make sure that you're going to do. Think of us as your mortgage personal trainer, right? If you want to get fit, you just don't work out one day and all of a sudden you're in good shape, right? The same thing with the mortgage roadmap is we have to do some things to get better. We might have to save a little bit of money. We might have to pay a little bit some credit off. There's a whole host of things that we're going to do. And so what we're going to do is we're going to set up benchmarks and then we're going to follow up with you to say, hey, how are we doing on those benchmarks? And it's not about judgment. Sometimes something happened, life happens, and we might have to kick the can down the road a little bit longer and take a little bit more time. Or sometimes we're doing even better than we thought and we accelerate and we shorten that time frame. One of the great rewards of this job is taking somebody who you had to who you had to say no to and say, but wait, here's how we can do it, having them do the steps and then closing on their loan.
Like you said, home buyers to homeowners.
Exactly right. We had a one that I particularly remember. I have a client that's become a friend. Really, a lot of my clients have become friends. But he referred me to his nephew. And his nephew, in the process of us trying to get his nephew mortgage ready, his brother, which is the boy's father, he'd passed away. And so he had to deal with that in addition to he wants to buy this house and everything like that. And going through that process with him, helping him even with the grief part, even though it had nothing to do with the mortgage, and then kind of getting us back on track to the mortgage and then watching him close on his loan. And he's been living there for nearly 2 years. It's unbelievably rewarding. I mean, it's rewarding helping anybody, but there's even more so when not only does somebody doesn't make it, but somebody has to earn it, and then you watch them do it. There really is a sense of pride, almost like watching your kid, do something extraordinary.
One thing that you do that I absolutely admire is when you're helping clients, you say, we are going to improve the credit score. We are going to help you with, it's always, we're going to need a little bit of this. We're going to need a little bit of that. We're going to make this happen. But you always say we instead of you.
Yeah.
Instead of this is your problem, it becomes our problem. And I really admire that because we always talk about how can somebody feel like they're on a team and not out there by themselves? Just something as simple as what you just said, we. And then you also said it's rewarding because it's almost like your child. And I've heard you on the phone when you're talking to somebody who is going through grief. And it could be a divorce. You know, in divorces, a lot of houses are sold, so new ones will be bought. And you go through that first initial conversation, hearing this person who is essentially in pain because they're losing a lot, and it's not just financial. And that vulnerability that they're sharing with you, you take the time to listen to.
I appreciate that. I take everything personally, right? I think you get personally invested. And one of the things that happens with people when somebody's getting a mortgage, fundamentally, they have a problem, right? They have a house they want to buy, and they don't have enough cash in the bank to pay for the house that they want to buy, right? So they need to borrow. They have a problem, they need to get a loan, right? And so a lot of times you go to somebody that says, okay, you have a problem. Let me see if I can help you with your problem. When somebody comes to me with a problem, their problem is now my problem. It's not your problem, it's my problem. And all I do every day is solve problems. And so taking that ownership and really kind of going back to the family thing is I work as hard for them, for anybody who comes to me, and I work as hard for them as I would if my mother was getting a loan.
And I've
Because
seen you that it
yeah,
doesn't matter the amount that's on paper. It could have 6 zeros, 5, 4, 3, 2. It doesn't matter. You're going
yeah,
to take care of them equally.
we did. One of the things that I'm kind of most proud of is just when we go through the loan process, every week we do a meeting where we talk about our files and everything like that and the loans that are happening. And one of the things that I had done early on is that I took the loan amounts out of our pipeline meeting. And the reason I did that is because I wanted to make sure that we were discussing a person, and we were making that person a priority, and it didn't matter what their loan amount, what their loan size was. So whether it's 50,000 or 5 million, everybody gets treated the same.
We've been on calls together, and it's really because I speak Spanish. So I'm there as a translator for you. And with that said, the other day, just being on a call with somebody who is already in their 50s, trying to buy their first property. And it was so meaningful to hear the wife start crying when we said, "You got it. You got approved."
Oh yeah, yeah, yeah. That was great.
To hear her joy. Do you know that she's been sending me text messages wishing me and my family the best? May God bless us. to and I just think she's saying she's saying it to me only because I speak Spanish. But that feeling of being blessed by someone who feels that you went beyond what you needed to do to help them, you bring that to people every single day.
Yeah, we close over 200 loans a year, you know, 300 sometimes, and I still get that feeling. Like every single time we close, it's a reward. I've never lost that. I hope I never do. Um, my mom's been in the business for 30 years. I don't think she's lost that. I think maybe it's hereditary. She bred it into me.
Y- Mom is a firecracker.
Yes, she is. Yes,
she,
she is.
she will go 18, 20 hours if she needs to every single day to make sure that things are done
Oh
with
yeah,
integrity and character.
yeah. The loan doctor staff is a machine, and part of it is my mother's great. She's tremendous. She's 76 right now at the time of this taping, and she still is still with it, and no she shows no signs of slowing down.
Now, with the four C's, going back to that,
Yeah,
when you are creating a loan for somebody, putting it together, the puzzle pieces,
yeah.
as you say, what is the most challenging part?
So it's funny. One of the most challenging parts is getting somebody with a lot of money to realize that just because they have a lot of cash, that none of that other stuff matters.
Oh, we have a lot of people
So
like
we
that
have
too.
we have a
Yes.
lot, right? I had a client that came to me that had $3 million.
Yeah.
He's buying a $1 million house. He's got $3 million in the bank.
That should be no problem.
Should be no problem. Can't understand why his cash flow, the lack of cash flow, is having an impact. And I go back to that metaphor in high school. You have to be proficient in all four areas to get the best rate and terms. Now, don't get me wrong. We're able to help them. It's just you have to structure it a different loan that may not take into account some of those other things that you need.
Okay,
Or
so
in his case, he was 59 and a half, so we were able to use his income in a different way, his assets in a different way. We could talk about more about that later.
when you say the best rate and terms, does that mean I should always check the interest rate?
That's a great question. So the rate, your interest rate is an important factor in how much you pay. Okay. At the end of the day, when you borrow money, right? You borrow money, you have to pay back the money that you borrow. And then your interest and your cost is anything you pay above what you borrow, right? So you have loan fees, you have interest rate and all that. And at the end of every single month or at the end of closing, you don't pay a rate, you pay actual real dollars and cents, right? Now that some of that may be based on the rate, but the thing that you have to be mindful of and the thing that a good loan officer is going to do is make sure that for you, whatever your situation is, that you're paying the least amount of cost for that to happen. Now, sometimes that's the lowest rate. Sometimes it's not because it depends on your situation.
So I understand the interest. What does the terms?
Okay.
Is that the 15, 20, 30 year?
So terms refers to the cost of getting the mortgage. So your appraisal fee, your credit report fee, the title charges, transfer taxes, all that kind of stuff, any discount fees that you might pay toward the rate. And we talk about interest rate in terms of APR. And here's a kind of a good way to think about APR. Imagine if I lend you $100 at 6% interest. At the end of the year, you're going to pay me back. If you pay me interest only, you're going to pay me back $6.
6,000.
No, $100.
Oh, it's 100.
$100.
Not
End of
100,000.
the year, right.
I'm thinking 100,000 because
Yeah, no.
mortgage.
I got you. I just
Mortgage
want to do
break.
small numbers just
Yeah.
because it's kind of easy math.
Yeah, it'd be a
it's-
lot to pay you $106,000 after you lent 100.
You know, feel free. I mean, I'm totally okay with it. Not gonna say no. But if in fact, if anybody's out there listening and I give them $100 and they want to give me back 106,000, I don't even care how long it might take you. So $100, $6 in interest. Now let's say that instead of charging you 6% interest, I'm going to charge you 5.5. But I'm going to charge you $2 before I give you the money. Okay? So now at the end of 1 year, you didn't pay
105 and 50 cents.
You paid $107.50.
Right.
Right? So you actually paid $7.50. You paid 7.5% interest if you closed the loan out in a year.
Right.
Now extrapolate that for 10 years. So if I had 6% interest for 10 years, that's $60 in interest, or $55 plus the 2, that's $57. I just saved myself $3. Now we're talking about small numbers and it's insignificant, but now magnify that when you're talking about $700,000, $800,000, $900,000, and it makes a big difference.
Hundreds of thousands.
Correct.
Okay. So I still want to know a little bit more about the 4 C's.
Okay.
Because we've tackled, I think, credit.
Yeah.
And not completely,
Yeah.
but we've touched on that. Collateral. Does that mean that if I need a loan, I need to have another house to show you that you can take?
That's another good question. Collateral is really about the property that is part of the loan, the subject property. It doesn't really have a lot to do with another property. It's really about the subject property. And so when you're depending on the type of loan that you're getting will dictate what the loan to value is. And loan to value is what that means is that's the money that you're borrowing divided by how much the property is worth.
So for, again, easy numbers, if the property were worth 100,000,
Right.
how much are you willing to lend on that?
Depending on your situation, but in the right situation, you could borrow the whole 100. But if you were putting 5% down, you would get a loan for 95.
But I'd have to show you collateral?
Well, that is the collateral. The property is the
Property
collateral.
is the collateral.
Right. And so your loan to value is going to also have another impact on your interest rate. So if you're borrowing 60% of the value of the property as opposed to 90% of the value of the property, right? You're going to pay a little bit less than you would at that higher number, right? Because what happens is a bank is really all about risk. A bank is just an investor. They're an investor in you. And when they're investing in you, the interest rate is their rate of return on their investment. Right?
And there's less of a risk if you put 40% down than if you put 3% down or 5% down.
Yeah.
Usually.
Correct. Yeah. From a risk assessment standpoint, there is a less of a risk. And so because there's less of a risk, that savings is passed on to you as a consumer.
Now, does it make a difference on how much the property is worth as far as putting it for collateral? Or is it just about the down payment?
So when we're talking about collateral, we're talking about it relative to loan to value. So loan to value is the loan amount divided by how much the property might be worth. So if you have a $500,000 property and a $400,000 loan, that's an 80% loan to value.
Mm-hmm.
Okay, which means you have 20% equity. Now, when you're making a purchase on a property, the loan to value is determined by the purchase price or the appraised value, whichever number happens to be lower. So,
Okay.
right, so going back to that, if I'm buying a house that's 500,000 and it appraises for 475, well, my loan amount is going to be based, and my loan to value is going to be based on that 475 and not the 500. Conversely, if I buy a house for 500 and it appraises for 550, right? I might, even though I have equity, my loan amount is going to be based on that $500,000.
Whichever number is less.
Whichever number is less. I actually had the call about that yesterday from a borrower who is selling a property that's worth about 450,000, and she's selling it for a little under 300,000.
Ooh,
Yeah,
why?
it's well, I think one of the things that struck me as odd is that she had the property listed for sale, and I think that because it was listed for sale for about 4 weeks, she didn't get any bites, and then she finally has this person, and I'm thinking if it's listed for sale for 3 and it's worth 4, either there's a disconnect there, or maybe it's not worth as much as you think it might be. But either way, what she was trying to do was get the person to buy her property for no money out of pocket. And in general, the bank wants you, especially when you're buying an investment property, which this was, the bank wants to make sure that you have some skin in the game.
That you are willing to risk as well.
Yeah, I mean, if in anything, right? If I'm buying something and I don't have anything to lose, right? And then something goes wrong, well, then I also don't have any motivation to make it work.
So we talked about cash flow, we talked about collateral and credit, but we haven't touched on capital too much.
Yeah.
So tell me a little bit more about capital.
All right. So capital, like I said before, is all about the money that you have and the money that you have left over when you're done.
Is that the 401k kind of thing or
Yeah, part of it
retirement
is your
plans and
401k.
those?
Yeah, capital is all about your liquid assets, your 401k, your retirement funds, investment accounts, checking accounts, savings,
Your
bonds.
emergency go-tos.
Exactly right. Exactly right. What can easily be converted into liquid cash? And when we talk about capital, I think of the 4 C's. Not that it's not important, it's probably the least impactful when it comes to the terms of the loan, right? You need to have it, especially capital becomes increasingly more important when you have multiple properties because the bank is going to want to make sure that you're going to be able to support your entire portfolio and not just this particular property.
So with the 4 C's, which again, because it's important, credit, collateral, cash flow, and capital.
Right.
Okay, of the 4 C's, we talked about credit being the one that we want to focus on the
Okay.
most.
Right.
Okay, because according to loan programs, and people many times don't know that there's more than just Freddie Mac and Fannie Mae and FHA. Those are the ones that everybody knows about, but there's so many. The difference between a 650 and a 750 credit score is night and day.
It does. So if we talk about credit, if we talk about mortgages and in the terms of how much is the mortgage going to cost me, right? Because people don't generally call me and they don't want to know how much their neighbor's going to pay. They want to know how much am I going to pay. And the pieces of their puzzle very much dictate that. And the pieces that matter the most in this order are credit, loan to value, so the capital, the collateral part, and then how we're qualifying you from an income standpoint.
Mm-hmm.
So those are the 3 things that are going to really measure what your terms of your loan are going to be. Those are going to be the ones that have the most impact on what your loan terms might be.
Yeah, and I've also heard you say sometimes having 2 people on a loan is not better than having one person on a loan, which is always surprising. Because you would think 2 people, 2 credit scores, 2 incomes, 2 everything would be better, but not always.
In lending, we have these situations. I think every business has these if-then moments. If this, then that, right? And there is no hard and fast rule that says this is the best situation to do in every situation. And so many times I get called by people and says, "Hey, my neighbor did this. Is this what I should be doing?" I'm like, "No, No, you shouldn't be, because here's what's different about your neighbor situation than your situation. So no, you shouldn't be doing that. So going back to your question about the two people, sometimes it is helpful to have two people. And I'll give you, when you have two people who have marginal credit and a lower down payment, it is better to have two people on the loan than one. Depending on the loan program, most loan programs use the credit score of the borrower with the lowest score. Okay. If that's the case, sometimes taking one borrower off, as long as the income and the other stuff matters, taking somebody off is not necessarily a bad idea. And one of the things that we do is we look at that when we're going through the scenario and we're talking to a husband and a wife, or even people who aren't married that are buying a property together. We're kind of getting into everybody's situation to see what's the best way to go forward for them.
I remember buying my first property. It was a small little townhouse. And it's not that I had bad credit. I just had no credit. I just very little.
Yep.
My mom served me as the co-signer, and I had to make her all kinds of promises. She was trying to explain to me, it's not my credit, it's her credit. It's not me who's going to have to end up paying for it. It's her. She went through that whole list of stuff. And of course, I kept my promises. But how do you feel about people being co-signers on a property that they're not interested in purchasing? They're just doing a favor for someone for.
Well, I think that being a co-signer means that you are equally obligated, right? There's a legal term that's called jointly and severally. What that means is that you're not only are you jointly obligated, but if that person can't pay, you're obligated on your own. And so when you're going to co-sign for somebody, make sure that you, one, have confidence in them and their ability to repay. Make sure it's somebody that you're close to. I certainly wouldn't co-sign for my neighbor unless we were dating. Then
Oh.
maybe, I don't know. But
What is going on in that doctor household of yours?
right. But no, I do think a lot of times people co-sign not realizing how much obligation they really have. Not that I'm against it. In the right situation, it works great. And for a lot of people, it's super helpful. Just make sure you kind of know what you're getting into when you do that.
If somebody does choose to be a co-signer for someone, does that limit them on their ability to get another loan for themselves?
Oh, that's actually a great question. One of the things that I will tell you is that when you co-sign for somebody, what you definitely want is you definitely want the person who you co-sign for to be paying the mortgage, and they want to be paying the mortgage directly. And the reason that you want to do that, and from their account that you're not a joint owner of, and the reason that you do that is because in 12 months, when you go to buy something, the mortgage company is not going to count that other mortgage against you as a debt. It's called a contingent liability, meaning somebody else is making the payment. We have a 12-month track record of somebody else making the payment, so we can pretend that for you, that payment doesn't exist. And so that is going to minimize the impact on you co-signing for somebody, but it does take a year for you to get to that point.
Okay, I can see that. So tell me, when it comes to lending, why is it that the Brandt Lending Team tends to seal more deals than a lot of the other teams in this bank or any bank, really? I don't see a lot of no's going out there. It's a lot of yeses.
We're better.
Why is that?
We're better.
But I mean, everybody's got the same rule book, right? Everybody's kind of working with the same interest rates and kind of the same closing costs. So how come you have so many yeses?
Part of it is that we do our job in a good way, and we kind of understand the process. I think that a loan has to make sense, and we make sure that the loan makes sense. We're not just throwing anything against the wall to hope that it sticks. We're really kind of making sure that it makes sense and we believe in it. And if we believe in it, then we're going to fight for it and make sure that it happens. The other thing that I use to just kind of equate equate like a different metaphor, sports is a great metaphor for kind of what we're talking about. In sports, in let's just say baseball, the World Series is happening now as we're taping, and the Dodgers once again are in the World Series. Why are the Dodgers in the World Series again? Why are the Dodgers routinely one of the better teams in the league? It's they all have this. Every single team has the same rule book, right? They all play by the same rules. They all have somewhat of a salary cap or whatever their salary restrictions are. How they sign players or whatever, and yet some teams are better all the time. And the truth is that in any business, sometimes you have people who do the same things, and they're not all equally as skilled.
Yeah, they just have better players.
They just have better players, and so we're
Right.
really good at taking the various pieces of somebody's puzzle and conceptualizing it and seeing how everything fits together, so that we're able to help them achieve their goal and turn home buyers into homeowners.
Richard Brandt, the loan doctor.
Yeah.
You do mortgages. Why the loan doctor?
Oh, so setting up people for mortgages. Part of it is all about setting expectations. So the biggest thing that I would say is one of the reasons they call me the loan doctor is because getting a loan can sometimes feel like a financial colonoscopy. We're gonna know your finances the way your doctor knows your colon. And so the loan doctor thing kind of just helps me kind of set that expectation.
No privacy here.
Yeah, definitely no privacy when it comes to your finances. But we all talk about it in a very professional and pragmatic way with no judgment.
Well, what ends up happening, and I hope people know this, obviously, when you go to your doctor, he talks about, in your case, you're talking about colon, right? He talks about that all day, every day with so many people that he is just not shocked by anything anymore, right? He could just freely here it is. But I think that happens to people working at the bank as well. Whether somebody comes with, like you said earlier, a 400 credit score, an 850 credit score, $1 million in the bank, or no money in the bank. These things are so routine that it's just, let's keep it moving. It's okay, no judging. It just becomes a normal part of the conversation.
Yeah, we're definitely it's a judgment-free zone, and
Yeah.
it's how can we help? What can we do? What do we need to do? If buying a home is a priority for somebody, then it becomes a priority for us, and we're going to help make that happen. And it doesn't matter where we're starting from; it's all about where we're going.
Have you had any funny stories? One of those stories that you go, I've got to repeat this without the names and without the numbers, but I've got to repeat this story.
Yeah, so so it's funny. I used to own a process service company. Um, that's the process service is when somebody's getting sued and somebody has to deliver them a document.
Oh, that at 10 o'clock at night, you get a knock on the door. Hey, I've got some
Correct.
paperwork for
Right,
you.
right. So that was my company. I can tell you then my stories were way cooler than some of my mortgage stories. But some of the interesting things that I've seen in the time that I've been in the business is we had a person who was doing a cash out refinance. They were getting $2 million and we needed to do two appraisals on their property. One appraisal came back at 3 million and the other appraisal came back at 6. I don't know
That's
how to explain
quite a
that.
difference.
That is quite a difference.
That's quite a
That is quite a
difference.
difference.
And which one does the bank choose? The lower one.
Well, the bank chooses the lower one. And in this case, the weird situation about it from an electronic standpoint, they also do an analysis of the appraisal. And the analysis of the $6 million appraisal actually scored better than the 3. In our case, it didn't matter for the loan, so we didn't make a big deal about it. But it was just something that kind of caught my eye that's a huge discrepancy.
That would also bother me as one of their neighbors if my house is valued in the higher end, right?
Well, I
Yeah.
think here's the thing with an appraisal. An appraisal is one person's opinion of the value given whatever material that he's looking up, right? And sometimes appraisers might have a bad day. They could have missed something. They're people, even if they're using AI to help with them, they're still human beings and they're capable of making errors. The one thing that we make sure that we do is that we get to the right number whatever that number is. It's not about influencing how much the appraisal is. It's about finding the actual fair market value. And so we do a good job of finding that even at times when the appraiser makes a mistake.
So if somebody feels like they've got their four C's together,
Mm-hmm.
okay, what is the first thing they should do? Should they create like one of those accordion files where they put credit, collateral, capital, cash flow? Do
Yeah,
they do that
no.
and just bring you, hey, here's my accordion file. Here's everything. What do they do?
Yeah, that would work. I think that when somebody the first thing to do is just kind of reach out, because it starts by telling us what your goal is, right? We are I talk about financial puzzle all the time, and fundamentally it might say loan officer on my card or loan doctor, but fundamentally what I do each and every day is I build puzzles. Somebody tells me what the goal is. The goal is, for me, the goal is the picture on the outside of a box, right? And then the next step, if you've ever built a puzzle before, the first thing that you want to do is you make sure you have all the pieces. Once I know what your goal is and I have all your pieces, then I'm able to figure out what's the best way to put those pieces together to make that picture. And sometimes we need a new piece, like we talked about with somebody with credit issues or something like that, where we need a new piece and we go, okay, here's how we're going to get that piece. But sometimes everything works together and we know exactly what we're doing.
Yeah, because you'll help people build that puzzle with you.
Correct. We do it together because it's all based on their goals, which is another thing that often happens. Is one of the things that we try to do, or not try to do, that we make it a point to do. We want to make sure that we give you the right loan for you. A lot of times you will call a lender and they will give you exactly what it is that you want.
Oh, that happens on the internet all the time.
Correct, right.
Well, first of all, they give you some spectacular interest rate, which is amazing because no one else has this number, just this interest, just this internet site. Then when you go in, you say, okay, I want that interest rate and I want it for this property and these are the conditions I want. And then you send it off and they respond with, well, let's get talking. If this is what you want, maybe we can do that for you.
I will actually give you a good story from an internet lender just because it reminded me of this. And I won't talk about who the lender is, but it rhymes with pocket. So this particular lender gave a rate quote to somebody, and they were thinking about going to Quicken. They reached out to me and they wanted me to quote them a rate, and I quoted them a rate. And my rate was about $300 different than theirs. Not enough of a difference where if I was going to switch, that I would tell them to switch. It just wasn't significant enough. But what I was able to do was I was able to show them we had 45 days to close, and I was able to analyze their credit and say, hey, if we do a couple small things with your credit, I can get your credit score over this amount of money or this amount, and when I get your credit score over this, your loan costs are actually going to get reduced by $2,400 more.
Because you took the time
Because
to
I took the
analyze
time
it.
to analyze the whole picture. And that's really where the savings comes in, is because people don't necessarily know. They don't do this each and every single day and know where the nuance is to get me the best rate in terms for my situation. And that's what
Also,
we preach.
when you deal with those big internet lenders,
Mhm.
you're not going to get somebody's cell phone or their office desk. You're not going to get those personal phone calls. You're going to press 3 for accounting, press 4 for those types of calls. With you, they can call you directly. You're going to be on the phone, you're going to be on the email, you're going to get anybody else in that needs to be in the call. You actually work one-on-one.
Yeah, I would say that the internet lenders have a place, but for people who want to have, people who believe in service and people want to be put in the best situation that they could be put in, the internet lender is probably not the right choice, and we might be a better option. We are a better option.
You are a better option.
Yeah,
So Richard Brandt, the loan doctor, you turn home buyers into homeowners
correct.
at the Brandt Lending Team.
Yes.
And you're pretty proud of that.
Very proud.
You've been in the business for years. Your mother's been in it for even longer.
Yeah, she's been in it for almost 40 years now.
And it's a family business.
It pretty much is a family business. I definitely am a believer in nepotism.
Oh, nice.
Yeah. My sister is on the team. One of my best friend from middle school is on the team.
And they're all very successful because I know them.
Oh yeah, everybody's doing really well. But the truth is, the reason that we're successful is because we help people the right way. And as long as we maintain that attitude, I think success is just a byproduct.